Well, good morning or good afternoon to you, wherever you are watching in the six time zones across the country. And welcome to today's webinar, the Morningstar 529 Update. This webinar is another in a series of informational and technical sessions from CSPN, the College Savings Plans Network. CSPN is an affiliate of the National Association of State Treasurers and represents all of the 529 plans across the United States, along with corporate partners, including program managers, consultants, and other investment professionals. For those new to CSPN, we'll have some information at the end of the session today for you to learn more and participate with us. I am Jim DiUlio of Wisconsin 529, and along with Andrea Fierstein of AKF Consulting, we will be your moderators today. We'll get to our presenters in a moment, but first, thanks to everyone who sent in questions as they registered. We have time reserved at the end of our session for our guests to address their comments. And if you have any questions today, you can access the chat box right there on your screen. Right now, we have everybody on mute. And so moving along, Morningstar is based in Chicago, but their financial scope and research is worldwide. They do extensive data collection and analysis of mutual funds and a variety of other investments and savings plans for individual investors, as well as for financial advisors, analysts, institutions, and asset managers. Many people use their research. But Morningstar also follows 529s with good articles and information for parents and families throughout the year on their website. I'm sure most of us on this call look forward to Morningstar's annual 529 plan rankings. It was just published a few weeks ago. Our guest panelists today are a huge part of that undertaking, and many of folks on the line here probably talked to them as part of that process. So with us today are Leo Atchison, the Associate Director of Multi-Asset Alternative Strategies and Manager Research, and Madeline Hume, an analyst in the same shop, Multi-Asset Alternative Strategies and Manager Research. They have both active participants speaking at a number of industry conferences, involved with the CFA program, and a number of other activities in investment research. So Andrea, do we have any last minute thoughts before we start?
Thanks, Jim. I really just want to thank Leo and Madeline really for their diligence in the plan rating process all year long. Also for their work throughout on the landscape analysis that comes out in the late spring. I think that's an important indicator of where Morningstar is overall. And of course, for their participation today. And with that, I'm going to turn it over to Leo to begin.
Okay, well, thank you so much for the very nice introduction. We're delighted to be here. 529 research is something that we hold near and dear and spend, honestly, a lot of time doing. We're on the multi-asset and alternatives manager research team, but our 529 research is a very large effort of ours that we spend lots and lots of hours and weeks and time on, months even for sure. So anyway, it's something we're passionate about and we like talking about. So we're happy to be here, and thanks to everyone that's joining. I'll kick it off on moving over slides. One moment. Okay, so this is our first slide. We wanted to touch on coverage and how we determine it. So there's several factors that go into coverage. We definitely want to make sure that the majority of college savers have access to qualitative, forward-looking views of 529 plans. I'm going to try not to read too much off the slide, but so basically, we think that when you sign for a college savings plan, it's 18-year potential or even 22-year commitment. So it's a big decision. And you want to partner with a plan or a state that you believe is going to continue to offer a strong product over that time period. So we really Morningstar in general, our mission is to try and help investors, and part of that is looking at some college savings plans and trying to help investors sort through them. So we definitely try to cover the majority of the universe. Assets are definitely part of the consideration, we cover the vast majority of the 529 landscape by assets, definitely over 95% of assets. So, again, that goes back to wanting to help investors make good decisions. So another thing that I would point out is that we consider investment merit. And so this is, by the way, this is not specific to 529 plans on how we determine coverage. This is also similar to how we determine coverage on mutual funds that we evaluate. Assets are a consideration, but investment merit is also a consideration. If we identify, for instance, a plan that we think is really attractive and is something that investors should know about, because they say it's really small, but like this is something that should be on people's radar, then that could be a reason for picking it up too. So it's definitely like a triage of things. And one last thing I'd add is sometimes there are economies of scale that are hard to ignore. If you evaluate a program manager that is running one plan very similar to another one, then we try to leverage that knowledge and might expand coverage to that very similar plan, because it's something we can do that it's efficient, and again, it's going back to helping investors make decisions. That expands our reach. So that may be why you might see some coverage of for instance, some plans like $200 million in assets versus some plans that are $500 million and we don't cover. That could potentially be a reason for that. So anyway, hope that addressed those questions, but happy to answer more if they come up. As far as our evaluation of 529 plans, so we use our 5-pillar framework, which has been pretty consistent over time. A few years ago, we wrote a paper that identified what we view as best practices to try and really make our process and evaluation of these plans as transparent as possible, and we've continued to update those best practices in research we publish and landscapes. So just real quickly, from a parent perspective, we're looking at both the oversight from the state and the investment manager. So generally looking for on the state side, states that are engaged and very very much putting the investor first, and trying to think like long term, what is going to be best for the investor? How can I ensure that this plan is set up to succeed over time? And you can really get a sense for that through discussions with some of the overseers from the state, and also not just the discussions though, but the actual results. Sometimes you can see there is more pressure being put on the asset manager in terms of like fees or like moving to a smoother glide path and things like that. Certain stewards put a lot of pressure on that, and so we think it's really important, and we put a lot of weight in that. In addition, from a parent perspective, we look at the investment manager that's involved. So we have a parent ratings committee, and what we do there is we leverage those parent evaluations from the mutual fund side, from our mutual fund research in a lot of cases, which I'm actually on the parent committee for that. So I'm involved in lots of those discussions. But basically it's centered on things like what's the whole idea is, what's the culture at the investment management firm? Is it a place that is thinking long term, trying to do the right thing for investors? Is it a place that people want to stay, and you can, like, for instance, look at the tenure and stability of investment teams. That's very indicative of the culture. If it's a place that people enjoy being, do they have the right priorities in place? Like, are they like from a business perspective, are they responsible about capacity? Will they do they just launch funds just sort of without a lot of rigor behind the process, or is it very thoughtful and like they're focused on the types of investment strategies that they're offering? So we would prefer the latter, obviously. If you launch a strategy that isn't very well vetted, then it might not even last for a full market cycle, and then investors, that could be a really bad outcome if it doesn't even have time to stay around for a whole market cycle. So the process can't even really prove its merit, right? Over, like, for instance, a 3 or 4 year period. So those are some of the types of considerations on the mutual fund side that we look at on the parent. I'll try to get through these a little bit quicker because I realized that took a while. On process, we focus largely on the design of the age-based portfolios. So it's kind of similar to how we evaluate target date funds, where we dig into the asset allocation approach, and how the asset class weights were split, how the underlying managers were selected, if those managers complement one another, what the process is for overseeing them, and then like the glide down. As I'm sure you're all aware, we think that a smoother process is better as it reduces market timing risk. So that's another consideration. On people, we focus pretty heavily on the underlying managers of the investment options, and here's where we really leverage our analyst ratings on the mutual fund side. Which follow the same type of medalist ratings: gold, silver, bronze, neutral, negative, and we look at like what percentage of assets are medalists. So that's definitely a component of that, the largest component of that. As far as when we look at price, so we first of all we look at advisor and direct sold separately from one another. We've compared those separately. And then within those, we've even gone a layer further, and we look at if you have only index, how does passive, how do you compare versus, for instance, like passive direct sold, we compare those versus one another, or active direct sold, we compare those plans versus one another. And when I'm saying active or passive, I'm referring mostly to the age-based portfolios, because we tend to focus on those most, just given their popularity and the fact that they are used more widely than in any other strategies in general across plans. So moving on to performance. It's good that this was intentionally put at the bottom. We put the least weight onto this. We've all heard the discussion that past performance is not indicative of future results, and that's something we believe. We're more focused on thinking about what's going to happen going forward, and a lot of times there's a lot of changes at plans in oversight or underlying investment options that will really lead to a different outcome than what you've seen in the past. So it's a backward-looking aspect. So that's why we emphasize that less, and have always emphasized that less, both in our 529 evaluations and mutual fund evaluations. So those pillars come out as scores of positive, neutral, and negative based on the research the analyst does, the calls that the analysts have, and then the discussions that we have with the analysts and as a ratings committee. So yeah, and then of course we assign our overall ratings at the plan level, and overall these ratings are based on conviction. Gold we have very high conviction that it's going to be a very strong plan over the long term. You can feel very good about partnering with and investing with this plan. That's what a gold signals. Silver is also very high conviction. There might be one or two things that could be improved that hold it back from being a gold, but overall, silver is a very strong recommendation. Bronze is also a recommendation. It's our lower conviction recommendation, but we still think it's better than the average plan in general. Perhaps for instance, like a silver rated plan would have like really strong people and process, whereas a bronze might have one or the other, or a difference could be that they have similarly strong people and process, but it's a lot more expensive than the silver, for instance. So it's it depends on a plan by plan basis. But yeah, so that's an overview. That's an overview of our evaluations of college savings plans. As you may have seen, we've come out with an enhanced methodology for evaluating mutual funds, and so we made a conscious decision, and it was a discussion that 529, the way that we evaluate 529 plans, it's separate from how we evaluate funds. So a 529 plan has a range. It has a range of investment options. I mean, it's really it's a different type of analysis than if you're evaluating one portfolio. So inherently, it's different. So it has not been. So we decided to stay with our approach that we have now for this year. That being said, we are constantly evaluating our evaluation process, just like we would expect any mutual fund manager to do or any 529 plan overseer to do. You constantly need to revisit and see if you can improve the way that you're evaluating whatever it is that you're evaluating. So we hold ourselves to that same standard. So we will continue to think about any potential any potential parallels that might make sense for, given what we're thinking about and how we're evaluating mutual funds versus 529 plans. So it's like a living and constantly evolving in hopefully a good way is our intention type of process. But to quickly touch on these the analyst ratings and how those have changed for funds. So really what it's done is it's new, so it rolled out in November officially. We've been working on it for months before that, but what it does is it identifies it more systematically basically rates investments, and so first of all, it more systematically takes out fees from our evaluation. So we don't actually rate price anymore. It just subtracts from what the pillars that we control and that actually can add expected alpha are people, process, and parent. So people and process take a bigger weight, and the way that it's done is you can see the chart on the right. What that does is it's basically we're trying to identify what is the opportunity set within an asset class, like what's the range of alphas. So we want to be reasonable in what we're predicting. So it makes sense to know what's the dispersion, and it can vary from one asset class to the next. Our global director Jeff Tech has written some articles about it that we can share links to if anyone's interested in. But the range of opportunity does change based on the category, and so it's become more systematic, and we've placed more emphasis on an analyst evaluating the aspects that are really most predictive of results of people, process, and parent, and it also puts more emphasis on fees, because we can basically by whatever we assign to these pillar ratings of people, process, and parent, if you give it like a positive, it moves. That's a predicted alpha that it moves it up by that much, and then basically the fees would just cut back that alpha, and if the fees cut it back to a point where it offsets all of the alpha based on the opportunity set, then it wouldn't qualify for a medal. So basically if you think about it on like a scale, if you give like people, process, parent, an above average instead of average. So each of those, people above average, process above average, parent above average, that would move the predicted alpha to the right, and then you just cut out the phi for each share class. And so wherever that lands, if it lands, on the positive side, so you still have positive predicted alpha, then it will earn a medal. And there's a distribution of medals. We have less gold than we do silver, and less silver than we do bronze. So it helps more kind of systematically divide the universe and our views. I know that was probably, well, that's a lot of information. And again, we can share lots of resources about that describe this if you want to go further on it. We have plenty of webinars that Jeff Patak, our global head, has conducted to review the process, and also a number of articles. So happy to provide those resources at any time. I'm going to touch on a few FAQs, and I'll address some of these, and Madeline might jump in on a couple of these as well, but I'll take a first stab at them. So one question that we get a lot is, why don't you take tax benefits into account? So really what we're doing is we're trying to, we compare 529 plans on a national basis, because we want to, show it improves the comparability and of plans, and basically it really does identify what we think are the best plans and the strongest ones, and which ones aren't quite as competitive. If you included tax benefits, then that could completely mask some kind of aspect, some kind of shortcoming of a plan, and then it wouldn't lead to it wouldn't be clear that that's a shortcoming, and it could hold a plan back from being what it should be if basically it's just a tax break forgives any kind of mistakes that we perceive. So we think that it helps, and on top of that, tax benefits, it's very person-specific situation. Like, you have to know, like, if you're making regular contributions or you're making like a lump sum. There's just so many assumptions that would have to go into it as well. So we think it's good to we highlight where there are potential tax benefits, but think it needs to be made at the personal level. As far as a formula for analyst ratings, that's definitely a question that we get a lot, and I've definitely talked about that in conferences, and I believe Madeline has too. No, there is not a formula. We try to be as transparent as possible about what we're looking for. In general, like I mentioned before, people, process, parent, and price are definitely the most important, and that we really consider all of those very heavily in our analysis, with performance being the smaller weighting. And the truth is that it can vary from one plan to the next based on something that's occurring, or it could vary, like if one pillar could dominate another because of some type of specific situation. In some cases, if you have, for instance, so if you think about a lot of plans that have Vanguard as the investment manager, they're very, very similar to one another. So what's the most distinguishing part of those? Is price, right? So price would become more of an emphasis, which would be similar to like how our passives team has evaluated index funds in the past. Another consideration is like if there, for instance, if there's a lot of uncertainty at the parent level, like it's going out for RFP, it's going out for bid, and that actually creates significant uncertainty about what the plan is going to be, then that can become an overwhelming aspect of the evaluation. So it I know I don't like when people say, give me answers that it depends, because I ask, I have been evaluating, funds for a really long time, and that's never an answer I want. But it's the true, it is true, and but we try to be as transparent as possible about how we're doing these evaluations. Who ultimately assigns the ratings? So as is shown here, analysts present what they propose ratings on all the pillars and at the overall plan level to a committee. We have a 529 ratings committee, and ultimately it has to be approved by the committee. And so those are very long discussions that we have. We spend lots and lots of time talking about these plans in committee meetings. Yeah, okay, so I think I touched on this before, but are we considering any changes to the way we evaluate 529 plans given the ratings enhancements on mutual fund side? Yeah, our evaluation process is always under consideration. We're always trying to make ourselves better and improve, so that the end result is so that there's better experience for the end investor. That's the mission at Morningstar. So we're going to do whatever we need to do to try and accomplish that, and that includes constantly trying to reevaluate the way that we're looking at things in our process. So I wouldn't expect and there is not anything planned at this point. But I wouldn't expect some kind of cascading changes at any point. But yeah, we're gonna just keep trying to do what we think is right for investors. I'll hand it over to Madeline now, in case she had anything to touch on here, or if I should just move on to the next slide, I can. Madeline will take it from there as well.
Yeah, I think, and thank you, Leo, and thank you everybody for being in attendance. We're really excited to be presenting to you all today, but I think you hit the nail on the head with most of these things. So we can go ahead and move on to kind of explaining our data collection process. So there have been some questions about how Morningstar collects data, and as a data company, that's understandable. It's part of what we do. And you can think about data collection as kind of a two-pronged approach here. So there's qualitative information, which is primarily under the purview of Morningstar analysts and the manager research team, and our ratings process is kind of a synthesis of all of the qualitative information that we've gathered, along with some more objective measures like price and performance. But then our data team is also collecting information from plans that's more quantifiable. So this is going to be keeping track of routine data points, like the start date of the program manager, the expense ratios of the underlying share classes, the investment manager that's involved. And so they're continuously working with program managers and other 529 stakeholders to update that information so that it's reflected in our products. So that's going to be direct, Morningstar.com, things of that sort. So sometimes plans are receiving information or receiving requests from multiple sources. That's because our data team and our manager research team, we partner up and we work in conjunction, but there are processes that they're working on and they have information that they're updating on a more frequent basis, whereas the manager research analysts are working kind of in two cycles. We have the rating cycle that starts in August and ends in October, and then we also have the landscape, which comes out in late May, and we're working on that in Q1 and Q2, or just Q1 actually of the year. And so essentially we're working together, but we also, kind of delegate responsibilities between those two teams. As part of the qualitative information that I mentioned earlier, we instituted a new RFI this year. There have been some questions about, the difference between an RFI and an RFP. So an RFI is not a formal solicitation for any sort of services. It's not a binding document. It's not a business request. It's essentially just an information gathering process that our team, Leo and I's team, uses across a bunch of different asset classes, typically where information is not as frequently published as it is in the open-end mutual fund space. So But we also do this for target date funds, which are open-ended mutual funds. But what it really does is it helps us kind of systematize our information gathering and aid the analysts in the due diligence process as they're going about researching these funds. That's their primary objective. It allows us to reflect back on previous years, build kind of a timeline of how plans are thinking about things, how their process evolves over time. But then the current year's information is also incredibly relevant to help us understand the methodology and also keep us abreast of any developments in the plans. So I think we'll probably touch on this in the Q&A too, but I hope that was kind of just an explainer of how we use these and what they're used for. So moving on, so we also got some questions about potentially how the parent pillar is evaluated, and this is certainly one of the pillars that we spend a lot of our time on, so we're happy to talk about it in depth. And I figure the best way to go about it is to kind of present some cases of what a parent pillar rating looks like, so you can kind of see what questions we're asking, how we're thinking about it. And as Leo did a good job of mentioning, it really is a evaluation of the partnership between the state and the investment manager to deliver the 529 plan lineup, asset allocation procedures, and the like. So we're typically going to be looking for long-term, stable, and diligent oversight from the people who are touching the plan the most. So, for example, here with Massachusetts, these are quotes from an actual ratings note that was presented to the committee by Jeff Holt, who's another director of our group here. So, one of the first questions we ask is the overseer stable and isolated from political churn? And so in his note, he cited that, they provide solid oversight, and the same people have been overseeing the plan for more than 15 years. And they've also benefited from not being vulnerable to political disruptions. So that was something that Jeff particularly called out. And then, have they chosen strong partners? Off the bat, Fidelity receives a positive parent rating from Morningstar analysts. And so, we reflect favorably on a parent fund complex that we think highly of in the open-ended mutual fund space. As it specifically relates to 529s, Fidelity has been building out its asset allocation efforts, and those have necessarily cascaded down into the 529 space. And the approach applies to all of the plans that Fidelity advises on, and so any improvements that are made to one plan are then shared with others, so they all benefit from each other's oversight in a way. We also ask if the state and any partners like an investment consultant, if they're acting as a check on the investment manager. We do want to see a healthy level of dialogue between the state and their partners to ensure the best college savings plan for the end investor, and so MIFA checks the box on that. And then, how is the plan responding to industry changes? The 529 industry, as you're all well aware, is a really competitive space, and there have been a lot of developments in recent years. And so, Massachusetts has been able to stay abreast of those changes by introducing legislation when needed to keep pace with what's going on in the rest of the industry. So I hope that gives a little bit of insight into how we think about the parent pillar, and also happy to touch on it in the FAQ as well. So we can go ahead and move on, Leo. And just to provide a little bit of color on, so we do the analyst ratings, and then we also produce a 529 landscape. So both Leo and I worked on that this past spring, and we'll work on it again this coming spring. And what we do here is we kind of look at the overall industry landscape and see, what the biggest sources of growth are for the market going forward, what the biggest trends are, and what we're kind of observing, and how our processes can naturally kind of improve to meet the innovations in the industry. So one trend that I'm sure you're all aware of that we've been noticing from our side is that asset allocation steps in age-based portfolios are narrowing. Plans are continuing to reduce the size of the steps that a participant takes as they move through the age-based portfolios. And as Leo mentioned, that does reduce the market timing risk of these portfolios, and we do view that as a positive development for college savers. But what we also appreciated was that our Morningstar categories, weren't necessarily configured to properly reflect the difference in structure between an age-based portfolio that is a fixed, 0 to 2 or 0 to 4 portfolio that isn't ever gradually de-risking, as opposed to a progressive glide path where as the participant ages, it's going to gradually move through those categories, and its longer term performance track record isn't going to be reflected within the category. And the category ranking, the risk-based ranking, all of those things. Additionally, as age-based portfolios that were fixed, we're also narrowing steps and taking smaller risks in more frequent intervals. The categories that we had were a little bit wide and had a pretty diverse array of solutions, under one umbrella. And so we thought that it would be a good opportunity to take a finer tooth comb to the age-based portfolios and have categories that accurately reflect kind of this massive shift in 529 plan options. So Leo, if you want to advance the slide, we debuted new categories this previous year to kind of reflect the changes that have happened to the industry. And so you can see we have age-based fixed categories that encompass the typical size of the steps that plans are taking. And then we've also revealed some target enrollment categories, debuted them rather, to capture plans that are gradually de-risking over the life of the beneficiary as opposed to remaining in one category over time. So we're looking forward to more plans being able to find categories for their options that accurately reflect the underlying asset allocation for investors. We also recognize and we study very closely, how these narrow steps are benefiting investors and ensuring that they have an impact on the overall investors. And so one of the things that we found in the landscape is the shift that the industry has gone through with regards to narrowing the steps has benefited investors. Moving from 4 steps, for example, to 8 steps really does result in higher money weighted returns as compared to remaining with a 4-step process. What we found with regards to progressive glide paths is that relationship is less direct, but we also recognize that there is more predictability within the returns, and so there is a much narrower band for performance, and there aren't these wild swings, which does benefit investor behavior in the long run. We've also realized and noticed over time, and you can go ahead and switch, Leo, that the quality of the underlying investments in these plans has improved. Over time, the percent in medalists that plans have held has incrementally gone up. And so that means that plans have better funds in their lineups. They're highlighting strong investment managers, and that will ultimately be of benefit to investors. And sorry, I'm kind of flying through the last couple of slides here, but I want to make sure we have time for Q&A. So we can go ahead and switch to the next one, which shows that across advisor sold and direct sold plans, and regardless of kind of the underlying composition of the investments, fees have come down quite significantly within the marketplace, and they are becoming more competitive and definitely approaching, although not quite meeting, the average expense ratios of comparable open-ended mutual funds. So looking forward, and you can go ahead and move to the next slide, what we kind of see is how the industry is going to continue to develop and to change. We don't necessarily take a stance on what is going to happen to the industry over the next 10 years, but there are some trends that may, impact assets under management in the industry, the continued growth of the industry. And so we see that on the growth side as increased awareness of 529s. As plans continue to get the word out and to advocate for college savings for these investments, we see that as a potential driver for increased contributions, greater flexibility to use the 529 college saving plan for other educational expenses like K through 12, and the potential expansion under the Secure Act to things like student loans and trade school can also be a way that plans would grow. And then also, frankly, as college tuition inflation continues to persist at a higher rate than CPI, I mean, not as high as it used to be, but as it does continue to be higher than just normal inflation, and college costs continue to rise, savings are going to have to increase to meet that shortfall, in addition to student loans and other elements of saving. But then on the flip side, there are a couple of factors that could increase consolidation. One is aging beneficiaries. So as 529 plans have been around now for a little more than 20 years, and so there are starting to be more persistent withdrawals from 529 plans, and that's as designed. I mean, the savings contributions were meant to be withdrawn at a certain point, and so as that persists, those withdrawals are going to advance and continue to come, and so there will be reductions in assets as a result of that. And then in certain states, aging populations are going to be a part of that as well. And then finally for advisor sold plans, as fee-based compensation structures continue to become more popular, that will continue to influence advisor sold plans and their potential growth or lack thereof. So with that, I think we will open up the floor to questions. And Andrea and Jim, I will pass it off to you. Thank you again, everybody, for joining us today.
Great. Thank you so much, Madeline and Leo. I think that you've really hit on so many of the topics that people raised questions about. Let me just jump right into one to begin with, because I think this really impacted many of the states this year. So I think that the RFI, I understand that from your data description, Madeline, and thank you for that you regularly collect data, and you've done it frequently, and I think program managers are used to those requests. But I think that the RFI came as a surprise to many of the state administrators, maybe even particularly given the late timing, and the proximity to when people were actually coming in and talking to you about their ratings. So I think one of the things we'd like to know, or one of the questioners would like to know, is how will you use, and I know you touched a little bit on it, but maybe you could be a little more clear about how you will use the information that you gathered this year, and whether in fact states should expect that you will release an RFI every year going forward now.
Yeah.
So
and,
I can. Okay,
sorry. Go ahead, Leo.
Well, I was just going to say I could start just because you kind of touched on the RFI throughout the presentation. So if you want, I'll take the first stab at that, and then you can.
Sure.
Okay. So this is my perspective on the RFI. First of all, we definitely did not mean to. We did not want for it to be like disruptive or stressful. I guess we view it as more of a kind of a common thing. We like as Madeline mentioned, we send RFIs to target date providers every year, and usually give them, I guess, the similar amount of time frame to fill them out. So it's largely used as a resource, and also like intended to build out basically an institutional database. It's a good way to get consistent, to get the same questions answered from all plans, and it's generally a good resource. It doesn't replace the calls that we want to have and the discussions in the meetings. It's just one added tool, and a way to ensure that we're collecting all the information that we want to for all of the plans. It doesn't signal any type of change in how we're evaluating 529 plans, or doesn't mean like there's increased scrutiny. If we would have known that it would be such a surprise to everyone, we would have made that very clear when we sent out the RFIs. But we didn't realize that would be the reaction. And so I guess I would add that I think we, and Madeline, you can correct me if I'm wrong, but I think we would like to send these out every year, just because it's just good to have this kind of information documented. However, at the same time, we would actually really appreciate hearing any kind of feedback, and we're not trying to create like an undue burden for anyone. And if there's a certain if there are certain pain points that we'd like to discuss, or if there's any way it could be made easier, or like if there's a timing that if a certain amount of time, if you would want more time for it, or send it at a different time, we're happy to listen and try to make it more manageable. Anyway, I'll let Madeline jump in if she has anything to add.
Yeah, I think that was a really good kind of summary of where we came from it, what angle we came from, and how we kind of thought about it. And so, now it's probably a good time to say mea culpa on this. And, we hope to give more advance notice in future years and hope that this can be kind of a collaborative process where we can receive information that informs the ratings. But, if there's things that we're not thinking of or questions that we shouldn't be asking, we're happy to hear from people on that too. And one other thing I did want to touch on with regards to how we use the information. So very explicitly, it is designed to assist the ratings process, and it's for the analysts to kind of review and to understand the process and the people that are contributing to the plan. But then we're also hoping to use the information in aggregate to help inform our research into college savings more broadly. And hopefully to encourage awareness of 529s and improved outcomes for investors. So kind of a two-pronged approach on that, but that is a secondary priority, and making sure that the analysts have enough information to rate the plans comes first.
Great, that's incredibly helpful. Thank you so much. Jim, you want to go ahead?
Yeah, we've had a number of questions where people asking about the key components for determining whether a plan should be upgraded or downgraded. Earlier you said that state taxes don't weigh a lot, and maybe it's just the 4 pillars. And so, if I were a state and I would like to upgrade, what should I be looking for?
Sure. So I can start that. I would say, okay. So first of all, one benefit that we have to evaluating 529 plans is that, as compared with when we evaluate other mutual funds, is that we do it all at once. So it's all very front of mind, and it makes it easier to stack, to basically compare plans versus one another, because we're talking about all of them at once. Because of that, we're very aware of any kind of industry developments, and we're aware of what we're looking for is basically plans that we think are making forward-looking improvements as opposed to reacting, and ones that we believe will continue to do so going forward. So whether that means because of like a process enhancement within the age-based portfolios, for instance, like a first mover toward a smoother glide path or progressive glide path. Some plans that have done that before we began talking about those and focusing on those types of things, or like for instance, like moving to finding a way to move to a CIT underlying strategy instead of a mutual fund because that saves on costs, like something like that. Like that is, it seems like that's really kind of pushing things a step further. So it's a moving target because the industry continues to improve in all kinds of areas. As Madeline has showed, the underlying investments have become stronger in our view. The glide paths have become smoother, so that raises the bar. In the past, if you had a smoother glide path, that would have more of that would be a larger consideration in terms of like, should this result in a positive process? But it doesn't necessarily. It's not as distinguishing anymore because the majority of plans have moved to that. So that becomes less of a differentiator. So it's basically I would just say we're looking for plans that we think will continue to remain at the front of the pack and like are continuously improving on the 5 pillars that we look at.
Well, good, thank you. Back to you, Andrea.
Great. So thank you for spending as much time as you did on the parent pillar. That is a concern both on the private and the public sector side. And I think you've hit on this. The factors that go into awarding a positive rating. So I'm going to ask this in 2 parts. Is there anything in particular you would emphasize when you talked about results? I mean, are there processes that we can focus on? And also, do you have a different view of the parent if it is a sole trustee versus a board that is operating?
So I'll address the second part of your question first. So the short answer is no, because ultimately what we're looking for from the parent is stability. And so we're looking for a body that is continuously evaluating its plan and making sure that its stewardship standards are up to snuff. And being an involved parent is reflected in our ratings. That can be achieved through a number of different structures. And there have been successful plans with boards, there have been successful plans with state entities, but really what we want to see, regardless of the composition, is isolation from political turnover. So, for a board, that might mean entity, like more board seats that go to people that have been involved with the plan for a long time, and not necessarily by virtue of a 4-year appointment, although plans do make that structure work as well. So that would be one way to do it. But then also on the trustee side, if there is turnover at that body and it happens to clear house every couple of years, we're not going to view that very favorably either. So really what we're looking for is stability and diligence. And so that does kind of feed into the first part of the question of anything in particular that you're looking for. And really what we want to see is a forward-looking body that really is committed to helping children save for college, what we're all here for. And doing that through quality investments, strong partners, and sensible asset allocation procedures. And continuing to foster a positive culture that will continue to emphasize those things going forward. That's really the things that influence our parent rating.
Great.
Right. So
yeah.
So then, as far as the first part of the question, you asked like what leads up like positive ratings? Is that that was it, right?
Yep.
Okay.
Yep.
So I think. Sorry. Go ahead.
No, that's it, Leo. You hit it.
Oh, okay. So, I think Madeline just addressed that as far as the parent aspect. For within people, we look a lot at the quality of the underlying strategies. So, we leverage our Morningstar analyst ratings, and so the better the quality of underlying investments, the more likely we are to think highly of the people aspect. Within process, we're going to ask questions about the age-based portfolios pretty heavily. That will definitely be a large focus, and specifically it would be behind like the glide path design, the sub-asset class weightings, and how they were determined. I would say importantly, we don't take a stance and say we think that you should have this much equity and you should start gliding down at this point at this age, and then at college we don't have a preference whether you have equity or not. It's more about the process that the investment manager used to get there. Like, do they have sound rationale for the decisions they're making, and is every single decision explainable? Can you explain? So why do you have 30%? Why do you keep 20% in equities at college? We're looking for basically well thought out answers.
Got it. Jim?
Yeah, we got another one here. I'm just thinking the typical family just tries to compare. So the question is, why don't you weight performance higher or highest?
Yeah, one of the reasons that we do that is, by virtue of the fact that we lie in a research organization that is focused on this, the predictability of performance and whether or not it influences future performance. And so a lot of the studies that have come out of Morningstar and that our colleagues have done has shown that past performance is really not the most significant predictor of future success. In fact, price is a far better predictor of a fund's potential for outperformance. So as a result, we don't take it into account as much, just given that we think that there are other predictors of future performance that are more effective than what happened in the past. Secondarily, as Leo mentioned, there has been a lot of change in the industry, and so a performance track record isn't necessarily reflective of an investor's experience to the same degree as somebody in an open-end mutual fund, just given that so many plans have narrowed their age-based asset allocation steps. And so it's pretty hard to determine what an investor's experience is like over their life, however long they've been in investment, when there have been frequent changes. But that said, we do take performance into account in our evaluation of other pillars, because we're always trying to verify whether a plan's investments are acting like we expect them to, whether the asset allocation procedures that a plan uses are true to what they're expecting to do. And so we're looking at performance more than is just reflected in the actual pillars, because performance is kind of evidence of a success of a previous process. And so we do leverage kind of that track record to consider other things.
Yeah, that's
On
a
behalf
really
of
good
all
point.
of us, go ahead.
That's a really good point. Just how we do consider it in the context of how it might relate to the process. So, for instance, if your process emphasizes downside protection, or like it's going to perform really well in an inflationary environment, like that's how we've structured it. Then okay. So, for instance, the downside protection. Well, how did you perform during Q4 2018 when the markets got a little ugly? So it can be like evidence of, it can be like evidence of and part of a process evaluation, for instance. But the actual numbers themselves, we try to put not too much weight on. We definitely care about performance, but we care more about future performance than past.
And I would also emphasize too that, we do, when considering performance, we do favor risk-adjusted measures. Just because we do appreciate that, different savers have different risk tolerances, and it's kind of, you can't eat risk-adjusted performance, but it is an indication that, you were effectively compensated for the risk that you were taking on. So we do lean on our risk-adjusted performance metrics more than just total return.
Good deal. On behalf of all of us that do securities compliance, it was a wonderful answer. Thank you. We're at the top of the hour, but we do have a few more questions. If you want to hang on, everybody, we'll try to get to them. Andrea?
Yeah, I think you've already touched on this, so maybe it's just a really brief response. There is sort of this sense that price may be getting a little bit heavier of a weighting than some of the other pillars. Can you refute that, or is it, I know you're always reluctant, and you should be probably, to assign a weighting to any of these pillars in particular, but again, there is a concern that there's an overemphasis on price. Do you disagree with that, or can you refute it, or comment on it?
Yeah, I would say when we're looking at the 5 Ps, we're really, as mentioned, examining the qualitative pillars with a lot of scrutiny. And we spend a lot of time evaluating them. But, when we're looking at plans that are of comparable quality, price can be a really crucial differentiator. And in the Vanguard example, if you're looking at 2 apples and one's 15 cents cheaper than the other, it's going to be hard to justify the more expensive apple. So it may seem in some instances like the only thing that drives the rating, but with so many plans offering strong investment options and thoughtful allocation processes, it's one way for plans to stand out, either positive or negatively, but it's not the only way. And so, if your plan is currently over coverage, you'll know that we take the time to speak with the investment managers in the states, and we spend months producing our ratings from August through October. If we had a simple price ranking, it would take all of us a lot less time, and we would ask less of your time as well. So you could all get back to, what you do every day, which is help kids save for college. But we firmly believe that a plan's investment resources will drive its outperformance over the long term. So we take a great deal of time and effort evaluating how these investments are constructed and vetted so that we can be confident in our convictions. And we're not going to recognize a cheap plan if we don't have confidence in the team behind it. And similarly, we will recognize plans that are more expensive if we feel that they have an edge over their peers that justifies their fee. So it is a balancing act, and it's something that we take into great consideration, and we try to synthesize within context as much as possible.
Awesome. Thanks, Madeline.
So we have another question. A lot of states offer both the direct sold and advisor sold plans, including shares for fee-only planners. So only 4 advisor plans received a metal rating. Have you given any thought to separate ratings between direct and advisor?
I can take this. So we don't want to say like within advisor sold we should have this many metals, and with direct sold we should have this many metals. I would say that the biggest reason behind why there are less metals on advisor sold really tends to be more of a case by case basis. Like we could walk through each one and discuss why it didn't receive a medal. There is fees they are more expensive, and even though we compare fees of advisor sold plans one versus another, and that determines a price pillar rating, we can't help but notice that a lot of times advisor sold plans have these really unreasonable expenses tied to them. Like for instance, it's not just a fee to compensate the advisor. Sometimes the advisor sold plans where you see like a 30 basis point program management fee or something like that. And so that you can't help but take that into consideration when you're looking at advisor sold plans. So I think that is part of the reason. Like we want to put pressure on those types of fees. And on top of that, I mean, again, we really determine these ratings from the bottom up. So this is a fallout of the process. It's not a top-down decision. But another potential contributor to that could be the fact that within direct sold plans, there's more use of passive, and within advisor sold plans, there's more use of active. There's a higher bar for active funds to earn a recommendation from our medalists. So there tend to be fewer medalists than what you see in direct sold. So that's also I'd say that might also be influencing that to some degree. But we don't want to force recommendations within the advisor sold space. We have like standards that we hold plans to, and we don't think that should really change from advisor versus direct.
Yeah, and ultimately, advisor sold 529 plans are still 529 plans. So they're tax advantaged plans that investors buy into to accumulate money for college. And so the objective for a direct sold plan and an advisor sold plan is the same. The investment universe is largely the same, and ultimately only the distribution channel is different. So advisor sold plans, they have to compete against direct sold plans for an investor's college savings. And so ultimately, it is a fair comparison to make between the two of them rather than separating, and doing different advisor sold ratings, because ultimately an investor has the choice between the two. And so, we have to also compare them against each other to accurately reflect that experience.
Okay, thank you, Andrea.
Great. Yeah. If we're still good with time, if anybody's still on with us, we just have a handful left. So I think, Leo, you touched on this just a little bit. You indicated that your metal ratings really are indicative of your conviction. And we understand the strongest conviction is gold. But could you be a little more specific about the differences between bronze and silver, which seems to be more nuanced, maybe?
Yeah. So, and I would agree with that as well. That view. We've reserved gold and silver for really high conviction. I mean, even though gold is higher conviction than silver, those are both very high conviction. And bronze is, it is a threshold. It's a threshold below silver, definitely. And there's more. There are more bronze than there are silver and gold. So I think I stated this earlier, but so it could be the case where perhaps there. So well, first of all, each of the pillar scores that you see, there's more granularity to it than what you can see as positive, neutral, and negative. So you can actually have two plans with a positive process, but one is more positive than another. So And that's become clear in our mutual fund ratings now, which actually show a 5-scale ranking system. So now process can, for mutual funds, this isn't shown in 529 plans, but for mutual funds, the process rating can range from high, above average, average, below average, and low. But before that, you were just seeing positive, neutral, negative. So first of all, there's more granularity behind it. So that could be part of it. Like for instance, that you might be thinking, why do we see the same pillar ratings for one plan, but then they have different end results? So that could potentially drive it. And then on top of that, let's see, I've lost my train of thought. Where was I going with that? So I think a lot of times you could see a case where, it's like one, I mean, it would be pretty obvious if it was like a silver rated plan is positive across the board. Bronze might have a neutral for process or people, or for price, or it might be expensive. So those would be the clear cut cases. I mean, in general, I would say that like silver rated plans, we're very confident in. Bronze, we believe in, but there are certain doubts that hold back our conviction, such as maybe the plans had a history of changing underlying funds a lot, or they just revisited their allocation approach and it seems pretty good, but are they going to stick with it and actually execute on it? So let's wait and see. Like we like where this is headed, but it's just a little bit more cautious. So usually it's just like there can be a little bit more instability. Those are a couple examples. Madeline can try to tackle it if she has anything to add.
No, I think you nailed it. I mean, really, the difference between bronze and silver is, just the analyst level of conviction in the plan, and so that can be expressed in a couple different ways. But it's ultimately just a difference in terms of our confidence.
Great. I think that means it's hopeful for bronze people who want to upgrade. I'd like to think that. Jim, do you want to? Yeah, we have just a handful left, and we have gotten a couple additional ones that maybe we'll get to. But Jim, why don't you either do one of the last ones that we have in writing?
Yeah, actually, some of your writers and analysts have kind of referred to the prepaid tuition plans that a number of states have, about a dozen or so. Is there any thought about looking at those, or is it a matter of or it's just difficult to compare?
Yeah. So we do. We are kind of the 529 ratings subject matter expert within Morningstar, but our editorial team that produces most of our content for Morningstar.com and other websites, they operate independently of us, and they often are tackling subjects like personal finance and when prepaid plans make sense and when they don't. So I would hesitate to speak for them on that, given that I'm sure their analysis is really well explained within the articles. But where we do take prepaid plans into account and where we think about them is when they intersect with the investment plans. So we don't necessarily take a stance on how they are as an investment class, but when we see something like a 529 plan where the investment plan fees are funding a prepaid plan shortfall, basically anytime that one group benefits at the expense of another, that's when we'll start to take a look at prepaid, and it will depend entirely on the case-by-case basis, how we're perceiving that relationship, but that's typically where we'd intersect with prepaid plans. But otherwise, we don't really necessarily have a stance. Our editorial team does in certain cases, but our ratings group does not.
And I would add that we don't have plans to begin evaluating prepaid plans. We haven't in the past, and we're not planning to, especially just given the trends and where assets are heading. Some of them are closing. Some prepaids are closing down, not accepting new money. So it's just not really the direction that a lot of states are headed.
Mm-hmm. So thank you for that. So maybe just two more, I think, Jim. if it's okay if I jump in.
Sure, please.
You know, you guys do such a wonderful job on the fund analysis side, but we do see a slight movement at the plan level of potentially getting cost savings on investments by using separate accounts or general account products. You know, structures that are outside of that traditional mutual fund, you know, 40 Act mutual funds. How would those, or how do those affect your view of a program, given that maybe it doesn't lend itself to something that you rate on the fund side, but in fact plans to do it for cost savings? How do how would you take that into account?
Well, one benefit of the Morningstar kind of ratings philosophy and complex is that we're often looking at you know, a particular investment process from a strategy level. And so as part of the enhancements to our ratings methodology, we're also kind of expanding our reach to apply the rating of a particular mutual fund to any comparable investments that are offered in a different vehicle, so perhaps a separate account or a CIT or something of that sort. So Leo and I, in our other coverage outside of 529 plans for target date funds, we cover CIT versions of open-end mutual fund strategies that we rate. So, you know, where there is a shift from kind of that more publicly traded vehicle into a more customized or lower cost vehicle, typically the analyst is able to capture that in, you know, a comparable rating on that product. But even where we're not, you know, part of the job that we do as analysts and part of the due diligence work that we do is understanding that, you know, the percent medalist underlying a plan isn't everything. And so we acknowledge that there may be opportunities for a plan to swap out a more expensive vehicle for a cheaper one and get ultimately the same product. And so that won't be, they won't discount a plan for doing that, and it won't, you know, penalize a plan unfairly for doing so. So, you know, we're not unfairly out here to emphasize specific vehicles at the expenses of others. I'd say we're, as a group, trying to be very vehicle agnostic.
Great. That's terrific. That's a great answer. Thank you for that. And then I think I have one more question with respect to in the advisor space, how you, and then we do have one last submission, I'm sorry, but how do you account for upfront sales charges on A share classes, or even a C unit that converts, a convertible C share class? Have you taken those into account? How do you, or, you know, is it not something that you consider?
I would say that we take them, I mean, we take them into account. They're in like our ratings notes, and you know, we've put less emphasis on them, with the idea being, you know, it's a one-time fee, because, like, you know, the ongoing expense ratio will be the more important component. Yep. Over time. Right. So it is something that we consider, but you're right. We haven't emphasized it. Well,
there's also the instances where the load is waived, and so, you know, it's hard to fully capture the extent to which the load is waived. So reflecting that it's not always being paid, we do take it under less consideration.
Got it. I see one more question. Yeah, go ahead, Jim. You go ahead.
Yeah, and then we can do a short answer on this one. A lot of states tinker with their glide paths. A lot of program managers do. What's more important, the actual the steps in the equity fixed ratios, or the underlying investments?
So as far as I'm concerned, I think they're equally as important. You know, both the building blocks and the actual result of the house, you know, are very important components of consideration. So I think that the asset allocation approach and the underlying funds are equally as important.
Okay, and I'm sure that's a question that keeps all of us up at night. So we're going to conclude. We're going to conclude there. You've got an extra 50% of webinar today for your praise. So I want to thank our guests today, Madeline Leo, along with all the Morningstar research team for today's information. I think we all learned something. And as we mentioned earlier, this webinar has been brought to you by the College Savings Plans Network. If you'd like to get involved, either as a state or agency employee, or if you're in the private sector, go to our webpage, collegesavings.org, and right at the top of the page are all the links you'll need. We have committees that welcome new voices and input. And for our current state and corporate partner members, a reminder that our annual all-state member call is coming up on Tuesday, December 17th, and you can watch for the invitation email. So we want to thank everybody for participating, and enjoy the rest of your day. And please have a nice Thanksgiving holiday next week with family and friends. Take care now.
Thank you. Thanks, Leo and Madeline.
Thank you.
Thank you,
Thanks for having
everybody.
us.
Bye-bye now.
Bye.
Mm-hmm. Okay, Chris, are you still with us? Mm-hmm.